Hello, I'm Pat O'Hare, Chief Market Analyst for Briefing.com. Today is Monday, July 21st. It's hard to know what to make of the latest earnings report from Bank of America. On the one hand, its top and bottom line results were better than expected. On the other hand, it was clear that credit quality continues to deteriorate, which potentially sets things up for disappointing results down the road. In looking at the market's response to the report, though, it is clear that the market's emphasis has been placed on the good over the bad. Shares of Bank of America are up 8% as of this recording, continuing a massive rebound off the low of $18.44 they hit only a week ago. If nothing else, the second quarter report underscores how the market got carried away to the downside with its earnings expectations. Driven by record quarterly net revenue of $20.3 billion that reflected the addition of LaSalle Bank but not Countrywide, Bank of America posted a profit of 72 cents per share. The latter was down 44% from the year-ago period, but was 19 cents ahead of the consensus estimate. The Global Consumer and Small Business Banking Unit drove the net revenue gain with an 11% increase to $13.1 billion. Strikingly, though, it also led the year-over-year decrease in earnings as net income for the unit fell 66% on account of higher credit costs. In the period, the unit's provision for credit losses increased by $3.45 billion to $6.55 billion. Total revenue for the Global Corporate and Investment Banking segment was up slightly, but again, the provision for credit losses was up noticeably from the year-ago period. Still, the segment logged a 3% increase in net income as lower non-interest expense partially offset the higher credit costs. It was reported that write-downs totaled $1.22 billion in the quarter. That was less than analysts were expecting and a market improvement from the first quarter when write-downs totaled $2.81 billion. That realization and a declaration from CEO Ken Lewis that he will recommend the board retain the current quarterly dividend at 64 cents per share triggered the favorable response to the report, as it engendered a sense of relief that the worst of the marks may now be behind Bank of America. The addition of U.S. Trust and LaSalle fueled a 21% increase in net revenue for the Global Wealth and Investment Management Unit, but a higher provision for credit losses and a 25% increase in non-interest expense were offsetting factors that left net income essentially flat for the period. Overall, Bank of America's net interest margin increased 33 basis points to 2.92%, and its Tier 1 capital ratio rose to 8.25% versus 7.51% at the end of the first quarter. The return on average assets slipped to 0.78% from 1.48% in the prior year period, while the return on average common shareholders' equity dropped to 9.25% from 17.55%. Book value per common share, though, ticked up to $31.11 from $29.95. At its current price, Bank of America is trading just below book value. That would qualify as a steal in a normal environment, yet this is anything but a normal environment. Worries about further write-downs, a weakening in credit quality, and macro concerns are keeping the stock from trading at a fuller valuation. These are legitimate concerns, yet we expect Bank of America to emerge from a downturn in a stronger spot given its quality management team and opportunistic acquisitions that have strengthened its long-term competitive position. Given the scope of the recent move, the stock is up 62% in the past 4 sessions, we wouldn't chase it at this point. However, we think a pullback on the order of 10% or more presents investors willing to accept near-term volatility a nice opening to take a long-term position in this industry leader. I'm Pat O'Hare for Briefing.com. Thanks for listening.